Welcome to Evidente's first video log on the Murray Report, which, when you take a step back and extract from the detail, what the Murray Report is actually trying to do is actually quite admirable, which is restoring much needed trust in the financial system and particularly in banks. Trust that had been lost, broadly speaking, since the financial crisis, and it remains low. And that can only be a positive. To the extent that that trust gradually is restored, can only be a positive development for society and also more broadly for the banks, even though no doubt the banks will continue to complain and whinge about the high capital requirements that they're going to be subject to. To that end, on the topic of capital requirements, that's pretty much where most of the action is and of most interest to investors, given that obviously banks represent or account for about 30% of the index. I'm glass half empty on this. I'll kind of give you the good news and then I'll give you what my version is of the bad news. The good news is that Murray continued to draw attention to the fact that the Australian banks' capital ratios remain below the global median. He provided a bit more detail in the draft report, suggesting that it's about 200 basis points below that global median. So it remains to be seen whether the Treasurer eventually does pick up on this recommendation. So the welcome development is that capital ratios are heading in the right direction. My own view is that the Murray Report represents a lost opportunity, the one that got away in terms of not recommending high enough capital ratios for the Australian banks, particularly given that we're so reliant on offshore capital. There's been some academic work, well-established and well-cited academic work, which suggests that capital ratios should be lifted substantially higher. Otherwise, taxpayers remain on the hook for banks' excessive risk-taking. Insofar as the implications for dividends, I wrote a mea culpa blog post about a month ago, which showed that amongst the top 100 global banks, those that actually have more equity in their finance or in their liability mix actually pay high dividends. So, and that's reasonable to think that safer banks will actually be confident to pay high dividends on a sustainable basis going forward. So, any implications for the higher bank capital ratios for dividends isn't actually a negative one. I actually see it as a positive development. Overall, what this actually means for your portfolio construction, I'm still comfortable being overweight, having a small overweight in the banking sector, and in fact I'm not surprised that there was actually a positive reaction to the report in terms of the bank's price reactions today, given that the politics of banking obviously favour the big incumbents. But I continue to be comfortable having a small overweight in the near term for a number of reasons. First, the payout ratio for the sector is about 70 to 75%, and that's in the historical range. Valuations are not stretched. The sector is trading at a 10% premium, 10% discount to the market, which is in line with historical median. Third, the bad and doubtful debts are low. They've kind of fallen to below 20 basis points, and they remain well below the long-term median, which I think is a better measure than the mean as far as the number going forward. But as long as business credit remains weak, and as long as those animal spirits in the corporate sector remain dormant as well, I see very little risk of the bad and doubtful debts rising in the near term. And finally, the National Accounts last week confirmed that the economy remains in a nominal recession and has been in that or stuck in that recession for 3 years. And against that backdrop, I think that investors will continue to reward companies that return capital to shareholders. So, short, just to recap, in the near term, happy to retain a small overweight in the banking sector, but over the longer run, the fact that I think that the key fundamental problem hasn't been addressed by Murray, which is the fact that banks don't have enough loss-absorbing capacity or loss-absorbing capital in their balance sheets. In the long run, what that means is that at some stage, the sector will be vulnerable to the next crisis of confidence, wherever that's coming to. And just by way of example, it will take less than a 12% decline in house prices to effectively wipe out all the banking sector's common equity. Happy to get any feedback for Evidente's first log, and look forward to speaking to you soon.